Good morning, everyone. Welcome to this update for global stocks and commodities. And whilst there wasn't a lot of action last week around general stock markets, it was certainly positive for gold. Not in a major way, but certainly the signs are pretty positive, and they just keep stacking up. Now, not a lot to report this week, so this will be a bit of a shorter video for those of you that want it in a bit more succinct fashion. But I'll just start with a couple of comments just to kind of set the scene. And I've in correspondence with quite a few members and non-members, so I've got a pretty good idea about the sort of questions and thoughts that are going through people's minds. And this is really getting to one of them, and that's how you respond during corrections in markets. And I just want to make the observation that when markets fall in price, generally the media headlines are pretty poor and negative in all sorts of respects. And so that makes it doubly hard when you're watching the price of stocks that you own go down and it's accompanied by the press telling you how bad things are. So it does make it very hard to stay focused, and that really is the challenge of the stock market for most traders and investors. But the reality is that bull markets exist about 75% of the time. And so at most 25% of the time, markets are in decline. And quality stocks will almost always make new highs after the decline, unless something has changed in their financial fundamentals. So you've got to remember that. However, whether you're a trader or an investor is really important to be clear about. If you're an investor and you've bought a good quality stock and it goes down after you buy it, then there's a case you can make to just sit on it, knowing that the high probability is that the price will go back above your entry at some point in the future. And so there's often not a requirement for investors to do anything much. But traders really should have a different outlook. Traders are really more about observing stop losses, taking profits when appropriate, and generally being more active and trying to work with the positive and negative parts of the cycle. So it's very important for you to be very clear about who you are and what you're trying to do. And I often get questions from non-members asking me about whether they should do this, that, or the other. And it's impossible for me to answer that because, we need to know exactly whether you're a trader or an investor, what your time horizons are, what your risk profiles are, and all those sort of things. So, it's not an answer that can be made in isolation. Now, drawdown in your account value is generally pretty confronting for most people. I understand that. But you've really got to try to keep the emotion down to an absolute minimum because when your emotions are engaged, you're just not making good decisions, and you just need to stay focused on your game plan. Now, US earnings have started in the last week. It's early days, but the results are better than what we've seen over the last 4 or 5 quarters. And I do note that the spread between what's called the earnings yield, which is not the dividend yield, so this is the total profit as a percentage yield of the share price. So the difference between that, which for a lot of American companies at the moment is around 6 or 7%, and high quality bond yields, which are still less than 2%, remains significant. And while that huge gap remains, then there's absolutely no reason for a rotation out of stocks into something else. And the price ratios are not as unreasonable in American stocks as many of the bearish commentators would have you believe. Price to book ratios, PE ratios, and a lot of other financial metrics are not that stretched. They're not great, but they're not stretched to the extremes that many are trying to paint. And at the moment, bullish sentiment is not a record low, but gee, it's not that far away from it. It's just 23% of people are bullish. That's by the American Investors Association. And this is just not the environment where market tops occur. So there's a lot of debate at the moment. Is this the top in the market? Is the market rolling over? And look, I can tell you that it's just not where market tops occur. Turning now to the American stocks, the S&P was down 21 points on the week. It remains anchored and may stay there until after the election. There's really just not very much going on in the US market at all at the moment. It's not being helped by a stronger US dollar, which has spiked up quite a bit in the last couple of weeks. So let's take a look at those couple of charts. So we'll start with the S&P, and you can see that really it's just been flatlining it for some time. We had a breakout here on the 11th of July. The market managed to make a bit of a gain, almost got to 2200, and then since then it's come back and it's just bouncing around the breakout zone at the moment around the 2130, 2140 mark. So there's very, very little to be discerned from that chart, and so I'll just move on because really nothing has changed. Now let's just look at the US dollar index. So you can see it's been very strong. It's moved back on the start of October. It was down around 95.3. We're now close to 99. That's a pretty big move. A lot of that is because of weakness in the euro, but nevertheless, the US dollar is looking stronger, and that's not particularly helpful for the stock market. But I think this rising US dollar is another reason why the Fed is perhaps unlikely to pull the trigger on higher interest rates in December. Moving on now to the Australian market, the Aussie dollar finished steady at 76. Our index was virtually unchanged, down by 3 points on the week, so nothing really much happening there. There's not a lot happening in the top 100 stocks at the moment, except those that are disappointing the market in any way are being absolutely slammed. I mean, I've never seen a market as brutal as this one for fairly minor indiscretions. So you've just got to be, pretty careful and cautious. And last week I made the point that you really want to just be buying significant dips and just restrict your activity to that, because if you are buying even a really good quality stock and you're paying the current market price and it disappoints in even a minor way, you can suddenly be down 15 or 20%, basically in the space of a day or two. So you do need to be careful about what you're doing in the Australian market. Having said that, though, there's some outstanding growth in some of the microcaps and small cap stocks, and members are starting to see the benefits of some of those, and it looks like that's going to continue because that's where the potential growth is. In the top 100, a lot of those stocks are going to struggle to grow earnings. They're reasonably fully valued, so there's absolutely no reason why the share prices should go up at all. Turning now to precious metals, gold rose by $20 on the week, and it's pretty clear, whilst that's not a big move, and we didn't see major moves in the stocks, but there's a lot of positives that are starting to stack up now, and it's pretty clear that investors are rebuilding. If you look at the holdings in GLD, they're strong. If you look at some other factors, which I'll get to in a minute, it's pretty clear that the investors are carrying the way, and that's the way it always has to be. A bull market in precious metals will never be sustained by speculators in the futures market. Never, ever, because they don't have enough money to bring to bear to sustain a bull market. Speculators can start bull markets because they get people interested and excited that things are happening, but it is investors that have the weight of money to sustain a bull market. And so we need to see investors buying, and that's what we're seeing. Now, in a highly unusual event last week, speculators continued their sell-off in the futures market. So that's the third week in a row, and there's been something like 80,000 contracts on the long side have now been liquidated, and that's brought that level of overhang right back down to normal levels. So I'm feeling really comfortable about what's happening in the futures market now. But the unusual thing is that gold rallied, even though speculators were selling. So that tells you quite clearly that the investors were buying more than speculators were selling, and that's just perfect. That's exactly what you want to see. The other things that were positive is that prices in India, the gold price in India, had been trading at a discount to the futures price for some time, for some months. That has now flipped back to a premium. So in other words, if you're wanting to buy physical gold in India, you're now having to pay a premium to the official futures price. And of course, the other thing is that Chinese imports increased the most since January of this year. So these are all really positive signs. Now, stocks, gold stocks and silver stocks are certainly showing some leadership, which is what we want to see, but it's not that much at the moment, as you'll see from the chart. So it's only early days, but I think if you're underweight precious metal stocks, it's okay to start rebuilding. If you are still holding a relatively solid position and you've held it through the correction, then I probably wouldn't extend my exposure to precious metals just at the minute, because we don't really have confirmation of gold stocks really starting to solidly perform. So let's take a look at those charts. So first of all, let's look at gold. So there's the gold on a daily chart. You can see we did tick up from around the 1250 mark. So not a bad week. Definitely a bit of a pickup, but nothing dramatic there yet. And if we look at GDX as a proxy for the market as a whole, we broke the first support level here around 25. We didn't quite make it down to the 50% retracement mark, but it's pretty close. And now we've bounced back up into this previous area here. So we've moved from a low of 22.5, and we're up to almost 25. So there's about a 10% move in gold stocks, and gold, of course, has probably only moved about 1%. So definitely gold stocks leading, but nothing to really get hugely excited about. But I think at this stage, if you're underweight, strategically, you can probably start to increase. Other commodities, copper slipped to 209. That was really just the US dollar effect. And crude oil held up very well. With both precious metals and crude oil, they both held well considering the US dollar went up. So that the US dollar rising was putting, of course, a depressing effect on all commodities, but crude oil managed to hold firm, as did gold. So the sector is looking positive. However, as I've been noting for months in the precious metals market, there's a huge overhang of speculative longs in the oil futures market as well. That's way too high. It's way above historic levels, and that needs to wash out, as we saw with gold. So I'm not enthusiastically embracing oil and energy stocks yet. I think if the oil price did cop a bit of a hit and fell back into the 45 to 48 area, I think that'd be a good long-term buying opportunity. So just to wrap it up, the overall strategic approach, and this is the last slide that I had up last week, and I'll just repeat it because I had a number of questions and a lot of good positive commentary about it. So for anyone that didn't see last week or would just like to, think about these concepts again, I think they're really important, and obviously struck a bit of a chord with a lot of the people viewing these videos. So one of the things that traders and investors get really fearful of is not getting caught up in the next crash. I think the impact of what happened in 2008 is still in most people's minds. And so from a point of perspective, you really need to stop worrying about exiting around the top. It's just not that important. It really isn't. If you can get out within 5 to 10% of the top, then that should be your goal, and that should be an acceptable outcome. Now, if you've bought near the top, then you're probably thinking that's not a very good outcome. But you've got to try and avoid buying when prices are extended, when everyone's bullish, because that's where the tops are. So as long as you don't go buying when prices have just run up strongly, then you really shouldn't be in any danger of really losing much ground at all, if any. You will get a window to act and minimize any damage, because as I've gone through many times before with the S&P chart, what you get, and this is just consistent with market psychology, you get an initial big sell-off, and then markets rebound and form a lower secondary high. So you'll always get a window to get out, so there's no need to panic on the first initial drop. So I'm absolutely of the view that you can minimize or eliminate any damage just by doing a few good, solid, sensible, conservative things. So those things are, you can assist yourself by just buying significant dips in quality stocks on the way up. Don't buy them when the prices just run up 10, 15, 20%. You can assist yourself by retaining an open mind. Don't get locked into the fact that this particular sector is the only place to be, or you've got to do this or that. Just remain very open-minded about how you approach the market. And of course, the most important thing is that you can gain significant advantage by not panicking. As I've indicated above, you always get a window of opportunity to exit under better terms than generally the first initial drop. And look, most of all, we're still in a bull market. Everything's pointing to the bullish side. Yeah, there are people that are pointing to things that might be bearish, and they're trying to make a case for a big rounding top. But until it happens, then just ignore it. At the moment, we're in a bull market. So enjoy it, utilize it, because it might run for a few more years yet. And I come back to the point at the top, and that is that if you're clear about what you're doing and you're not buying into overly extended prices, then really whenever the next top occurs, and of course there will be one, then it's not a big issue. So really stop worrying about it. So let's wrap it up this week. We may get some more of this sideways action until the US election's out of the way, which has just become almost a freak show. I just can't watch it anymore. It's totally depressing that those two candidates are the best that a country of nearly 400 million people can throw up. It's an absolute joke. Anyway, we'll see what transpires next week. There's my contact details for any non-members, and be back with you next Sunday. Cheers.